How do Islamic investment accounts use Mudarabah contracts? If you are curious about how Islamic investment accounts operate, you are in for a treat. One of the key components is the Mudarabah contract, which plays a vital role in Islamic finance. Let's break it down in simple terms. In an Islamic investment account, the account holder is known as the capital provider, or Rabul Mal. The Islamic bank acts as the entrepreneur or manager, referred to as Mudarib. This partnership allows the bank to invest and manage the funds while adhering to Islamic principles. A major feature of Mudarabah contracts is profit sharing. The profits earned from investments are divided between the account holder and the bank based on a ratio agreed upon at the start. This ratio ensures that both parties benefit fairly from the investment, aligning with Sharia rules. Now, what happens if there are losses? In this case, the capital provider bears the losses. The bank, as the Mudarib, does not lose money unless it has acted negligently or violated the contract terms. Instead, the bank loses its time and effort in managing the investment. There are two types of Mudarabah contracts used in Islamic investment accounts. The first is the unrestricted Mudarabah, where the bank has full discretion to invest in any Sharia-compliant venture. This gives the bank flexibility in managing the investment portfolio. The second type is the restricted Mudarabah. Here, the account holder sets specific conditions on how the funds can be invested. This could include limiting investments to certain industries or geographical areas. All investments under Mudarabah contracts must comply with Islamic law. This means avoiding prohibited activities like interest, gambling, and investments in industries deemed haram, such as alcohol or pork. Transparency is also essential. The bank must provide regular updates to account holders about how their investments are performing. This builds trust and aligns with Islamic principles of fairness and accountability. In practice, Islamic banks use Mudarabah contracts to pool funds from multiple investors. These funds are then collectively invested in Sharia-compliant ventures. Profits are shared according to the agreed ratios, while losses are absorbed by the investors. In essence, Islamic investment accounts utilize Mudarabah contracts to create a partnership. The bank manages the funds for the investor, sharing profits fairly while ensuring that losses are the responsibility of the investor unless the bank is at fault. This structure supports ethical investment and compliance with Islamic finance rules.